Hi everyone. Give me a moment. Okay, hi everyone. Okay, hi everyone. Testing, testing. Not sure if you guys can hear me. Okay, testing. Hi guys. Sorry I keep getting disconnected. So I'm actually doing this cruise, doing this webinar on a cruise today. Internet isn't very stable. I keep getting disconnected. I'm not sure why. The last webinar that I did was perfectly fine. It's just that this one that I'm doing right now seems to be having some kind of problem. Okay. But it's okay. We'll try our best. Let's see how it goes. Hopefully I can cover the entire topic today without any disruptions. Okay. Okay, so again, hi everyone. Welcome to today's webinar brought to you by IC Markets. We're gonna do the beginner's guide to major economic data. Today's the 29th of June. I'm gonna quickly finish up this webinar today, just in case, um, you know, just in case we get disconnected again. So I don't want that happening. I'm just going to talk really quickly. Hopefully, everything's being captured. I'm going to turn off the camera so that less data is being used, I guess. Okay, I don't know how if that's how it works, but yes, let's try to make this work as much as possible. Okay, before we continue, you guys know how this works. I need to go through the disclaimer with you. Whatever I share in this webinar should not be construed as any form of trading advice, any form of investment advice, or any form of advice to get you to buy or sell anything. Okay, that is not the point of this webinar. The whole point of this webinar is so that you guys learn from different perspective of a different trader. You guys see the markets from a different perspective. You are here to grow as a trader. You are here to learn. You are here to yeah, basically see from a different perspective, but you are definitely not here to copy anyone's trades. I'm not giving you any form of investment advice. I'm not giving you any kind of financial advice. Purely here to help you understand the markets a little bit better so that you can kind of become a bit more profitable in trading. Okay, so I'm going to stay here for a minute or two so you guys can actually read through the disclaimer. Just a reminder, I am not in the office today. I am streaming from a cruise. Yes, I'm on holiday, right? I didn't want to cancel the webinars, but I'm streaming on a cruise. The internet isn't very stable. I keep getting disconnected, so just bear with me. If we get kicked out, stay on Zoom. I'll come back in. Okay, I'll come back in. Hopefully everything works perfectly fine. Okay, so bear with me. Anything in the chat box, just let me know. Okay, let me know in the chat box. I hope you guys are done with the. Let's move on to the next part of our webinar, which is introducing your host. So, for those who don't already know me, right? My name is Cassandra. You guys can call me Cass. I am an investment analyst and a prop trader based in Singapore with a research firm called Everest Fortune Group. We have been recognized as a finalist for the best forex and best equity research for multiple years running now. Okay, so what we do is when the markets are going. Okay, on top of that, time researching. I love spend a lot of time trading, and I'm also a funded trader. Okay. Like I said, guys, because the internet isn't very stable, I'm gonna try my best to finish today's topic really quickly. Okay, it's gonna be faster than usual. Don't worry. I will still cover everything that's needed. It's just that at a very quick speed. Okay, so let's start with inflation and CPI. Okay, so let's look at our first major economic data release that almost, right? Every forex trader will eventually encounter at one point or another in their career. Okay. Okay. So, and that is CPI. CPI stands for Consumer Price Index, which is essentially the main measure of inflation in most developed um economies. So at its core, CPI is simply a measurement of how much the average price of goods and services is charging over time. So if CPI is rising, it means inflation is increasing and the purchasing power of money is declining. So if CPI is falling, it means that inflation is cooling and price pressures in the economy are easing. Now, on the surface, that might sound like basic economics, but in the trading term, CPI is extremely important, right? CPI is extremely, extremely important. Testing, testing. Can you guys hear me? Okay, cool. You guys can still hear me. Okay, so why is it important? It's because it is directly influenced it directly influences the central bank behavior. So central bank have one primary mandate that matters most to markets, and that is price stability. And when inflation is too high, they are pressured to tighten monetary policy, usually by raising interest rates or keeping them elevated for longer. And this is where CPI becomes powerful in forex markets. It is not just a reflection of the economy, it is a forward-looking signal for interest rate policies. Okay, so traders are not reacting to inflation itself, but what inflation implies about future monetary tightening or easing. So when CPI is released, what the market is really doing is recalculating the possibility of future rate decisions. That recalculation is what drives volatility in currencies, especially the US dollar, euro, and other major pairs. Okay, so when traders talk about CPI, they are often not just referring to one single number because CPI actually comes in different forms, and the distinction between them is extremely important for understanding market reactions. The two main versions you will hear about the headline CPI and core CPI. Headline CPI includes everything in the consumer basket, including volatile component like food and energy prices. These components can swing sharply due to external factors like oil prices or supply shocks, which is why headline CPI can sometimes be noisy. So core CPI, on the other hand, strips out food and energy prices and focuses on the underlying trend of inflation in the economy. This is considered more stable and more reflective of long-term inflation pressures. Now, here's the key point that most beginners traders miss. Central banks tend to pay more attention to core inflation when making policy decisions because it gives a clearer picture of persistent inflation trends rather than short-term volatility. So when CPI data is released, traders are not just looking at whether inflation went up or down, but also whether core inflation is accelerating or slowing. Often, the reaction in the market will depend more on core CPI than headline CPI, especially when the two are giving slightly different signals. This is why you can sometimes see confusing reactions where headlines CPI looks stronger, but the currency does not rally as expected because core inflation did not confirm the same trend. Okay, so CPI releases are known for causing some of the most aggressive short-term volatility in forex markets. And the reason for that is not because inflation itself is volatile in the moment, but because CPI directly impairs. So CPI releases are known for causing some of the most aggressive short-term testing, short-term volatility in forex markets. And the reason for that is not because inflation itself is volatile in the moment, but because CPI directly impacts how traders and institutions pick for price future interest rates decisions. So when CPI data is released, it is compared immediately against market expectation. These expectations are already embedded into price through positioning, sentiment, and derivatives pricing. So when the actual numbers come out and market is essentially checking whether the inflation trend is stronger or weaker than what was already anticipated. If CPI comes in way above expectations, right, the markets may quickly adjust to the idea that the central bank needs to stay more aggressive for longer. That can lead to rapid currency strength, especially in high yields or USD pairs. On the other hand, if CPI comes in below expectations, it may signal that inflation is cooling, that it's cooling faster than expected. So, which can shift expectations toward rate cuts or a less aggressive policy stance. Where was I?